Um, uh, God, okay. I hope all of you are in a great health. What do you call it? Ready to learn today, this Friday. Kita tahu for Muslim Friday is a special day. It's actually where there will be Friday prayer, and when we pray, there are certain time that your prayer is going to be accepted, inshallah. So we'll proceed to today's topic on accounting theory. That will be the topic 4, where we are going to look at the basic assumptions of accounting principles, accounting concepts. Okay, this is for accounting theory, AKT 1.62.777001. Okay, for Bachelor of Accounting. Right. Okay, I want to move my slide. So I will just press next. It doesn't move. Mm, mm, what should I do? Okay, it doesn't move as well. Mm, okay, I need to stop sharing. What is happening? Right. Okay, what's happening actually? Mhm. Okay, so probably I will just go here and slideshow, slideshow, try, enter. Okay. So these are the contents of today's class or lecture. We are going to look at the basic concepts. If you read the history of these concepts are actually developed by these two accounting educators, Patton and Littleton. So until now, we are still referring to the same concepts. So you can actually search if you want to read the uh, the development of this concept by Patton and also Littleton. Yeah. So these are the 7 concepts as per your lesson plan or your syllabus that you really have to understand and able to explain about the concept and to relate the concept with the uh, financial statement, with what you are doing in recording, summarizing, presenting the financial information via the financial statement. So the first one is what we call business entity. Then we move to going concern, measured considerations, cost attached or accumulated cost. Or this is the cost concept. Effort and accomplishment. This is also known as matching concept. And then we have verifiable objective evidence, and also assumptions, materiality, conservatism, and so on. So what I will do is I'm going to show you the later, for example, when we record asset at purchase price, this is actually following which concept? It's actually following the historical cost concept, for example. Yeah. So hopefully I will be able to help you to relate the accounting, recording, financial accounting and reporting with this concept. Because and before that, let's just revise or recap or revisit our previous class, which we are looking at conceptual framework, which is very important. If you look at financial accounting and reporting are highly regulated. So we need rules and regulations. We need accounting standard. We need some accounting principles. So in the past, we are following the GAP. Have you ever heard of GAP? GAAP, Generally Acceptable Accounting Principles. Yeah. However, as we move into globalization and the more companies are actually operating in different countries, so there is a need for global regulation of accounting, financial accounting and reporting. So therefore, this IASB is the International Accounting Standard Board. In the past, it was known as IASC, International Accounting Standard Committee. So the International Accounting Standard Board, they are responsible to develop and issue accounting standards, which what we call IFRS. If you can recall, IFRS 16 for property, plant and equipment, IS 16. So so therefore, if, for example, if we want to develop or set a particular standard, we need to have a very good basis so that the standards are going to moving towards consistent rules and regulations. So that's why there is a need to issue the major guideline, which we will call conceptual framework. Yeah. So this conceptual framework was issued by IASB, and we have a new version of a conceptual framework, which was revised, amended in 2018. So it's going to be revised again in the future in order to make sure the financial statements are actually becoming useful, valuable to the company, yeah, to the users. So if you look at the conceptual, I think I've shared with you the PDF file, kan, conceptual framework, and you can see that it has 8 chapters, chapter 1 until chapter 8. So chapter 1 is for the objectives of financial statement, and we move to chapter 2, which is for qualitative characteristics, and chapter 3 for the financial statements. So we have statement of profit or loss, statement of financial position, and then what are the elements of financial statement? So FS is for the financial statement. So in the financial statement, you will see there are 5 important elements: assets, liabilities, equity, revenue, expenses. Okay. So therefore, when the IASB develop, for example, an accounting standard for asset, for example, an accounting standard for intangible asset, so they will refer to this chapter 4. Yeah. So what is an asset? And if we just, there are different types of assets. We have non-current asset, we have current asset. Non-current asset, we have tangible asset, we have intangible asset, we have investment property, we have biological asset. So all these are actually the subset of elements of financial statement. And chapter 5 is about recognition, which is very important, for it will guide us in deciding whether to recognize or not to recognize a particular transaction. Yeah. So therefore, for recognition, the guideline will be in chapter 5, and also the measurement. How do we measure asset, for example, liability, and so on. And chapter 6 on presentation and disclosure, which is very important. At the end of, we have worked very hard to enter all the transactions into the accounting system, and now it's about how are we going to present it, in what format, what information that we need to disclose. Yeah. So the guidelines will be there in the presentation and disclosures. And also chapter 7 is the concept of capital and capital maintenance. This is where it will help us to decide on how are we going to calculate or determine profit. So we look at the concept of capital and capital maintenance. So this is the conceptual framework. As an accounting student, we really need to know about the conceptual framework. What is there in the conceptual framework? What is the purpose of the conceptual framework? What do we get out of the conceptual framework? Am I too fast? Or you want me to go slower? Or is that okay? Okay, eh? Can I proceed? Okay, all right. So with regard to the conceptual framework, I would just want to check whether you can still remember about the qualitative characteristic of useful financial information. Can you tell me two qualitative characteristic? The one start with R, the other one start with F. What is it? Fauzan, can you still recall what you have actually learned last week? Akmal,
Pardon me, what's the question?
what are the qualitative characteristics of useful financial information? Any idea?
Relevan,
Again, I didn't.
relevan,
Uh-huh.
relevan.
Relevant. Very good. Relevance. That's good. That's correct. Yes, relevance. Another one? The second one?
Faithfully represent what is the
Presentation.
purpose to present.
Yeah, correct. Good. Faithful representation. So these two are very important. So for us to provide financial information which is useful, which useful meaning users can use the financial information in making economic decision. So whether to invest or not to invest in the company, whether to buy or not to buy the products, whether to lend or not to lend money, whether to what do you call it, give credit purchase or not to the company. So in order for the financial information to be relevant, to be useful, it must be relevance, it must be faithful representation of the company. Yeah, good. So for today, we start with the first concept, which is very important. It's called the business entity concept. So if you are very interested to become entrepreneur, there are many ways to become a businessman or a businesswoman because you can do the online trading, right? For example, now when we buy goods, we are, I mean, there's no need for example, if is the weather is not, it doesn't permit us to go out from the house, we can just do the online shopping. You can buy anything online. So so is widen up opportunities for people who want to become an entrepreneur or what we call business person, businesswoman, businessman. This is the first concept which is very important. So what we do for financial accounting and reporting, what is our main what is the main purpose of doing a business? You want to make more money, correct? You want to uh, get profit. So how are we going to calculate profit? We are going to prepare the statement of profit or loss. So when we prepare the statement of the statement of profit or loss, we need to find out what is the total sales or revenue for the whole financial year or financial period, accounting year or accounting period. So therefore, it is very important that, say for example, if Kartika is a businesswoman, she is selling this new what do you call it, clothes for women, for example. So um, here the business is considered as one business entity, which is actually different from the owner, Kartika, for example. So that if, for example, Kartika uh, take several clothes and give those clothes for herself for personal use, so we are going to consider this as drawing. All right. So, and for example, if Kartika uh, buy a motor car or motor vehicle for the business, so that will be considered as the business asset. So this is the first concept which is very important for us accountant, because we need to differentiate between the business and the owner of the business. So business is a separate business entity where we are going to consider business as its own, so that whatever transactions for the owners are going to be separated, will not be recorded as the accounting transaction for the business. Say, for example, if it is related to the business and the owner, for example, if Kartika inject more money into the business, this is what we are going to record as capital. Yeah. So we are going to debit bank, credit, capital. So this concept is very important, so that when we prepare the financial statement reflect the business performance and the business financial position, not the owner of the business. All right. So that is why we need to make sure when we record the transactions, we will only record transactions related to the business operation, related to the business, not about the owner. Say, for example, if the owner go out and buy lunch, that will not be recorded because it's personal matter, it's personal transaction. But if the business pay rental, for example, for the shop, so that will be recorded as expenses. Yeah, because it is actually related to the business operation. So here, this concept is going to separate the business from its owner, which is very important. So when we look at the financial statement, we know, okay, this financial statement is for Kartika Enterprise, for example. All right. So it will help users and also the business owner to find out about the performance of the business, how the business is doing. So we can look at the statement of profit or loss, for example, to see whether the business is making profit or not. And those expenses are expenses for the business. Yeah. All the personal expenses will not be recorded. So that's why this is the first concept you need to learn, and you need to be very clear about this concept, so that when you look at the accounts and when you see there is a receipt, for example, tuition fees, owner's daughter tuition fees. This is actually personal expenses. So we cannot record it as expenses for the business. Yeah. Okay. Anyone has any question? You're okay. Yeah? So the second concept is money measurement concept, which is also very important. How are we going to record a transaction if we don't know whether the transaction is in a certain currency or not? So for example, if you are in Indonesia, we are going to record transaction in rupiah. Yeah. So we cannot, like, for example, mix rupiah, dollar, ringgit. We cannot do that because these are different currency. So we need to stick to one currency. For example, in Malaysia, we are using ringgit. So in Indonesia, we are using rupiah. Yeah. So for example, if we have this A Berhad is also having a business operation in Singapore, for example, and the financial matters, I mean, if they are going to prepare financial statement for that particular business operation, but when we want to consolidate, we need to convert it into rupiah because it's an Indonesian company, so it must use rupiah. Yeah? So according to this concept, we can only record financial transactions if we are able to express it in a certain monetary terms. For example, in rupiah. Yeah? So if, for example, your business bought a particular painting and you don't know what will be the amount in monetary in rupiah, for example, you cannot calculate its value in rupiah. So how can we record it? We cannot record it. Yeah. So non-monetary transactions, regardless of their significance, do not impact the accounting records. We cannot record it. Yeah. We must make sure we can actually determine its amount in monetary terms. So, and this is actually, there's nothing that we can do about it, because accounts, we can only account for it if we can actually express it in monetary terms. If we cannot, then we cannot record it. Yeah. Even though we know it's very priceless, it's very valuable, but we don't know what will be the value in monetary terms, so we cannot record it. Yeah. Okay. So this is the money measurement concept. The third concept, which is going concern concept. This is also very important, because when we prepare the financial statement, we assume that the company is going to be going concern. What does it mean by going concern? It means the business is going to operate in the near foreseeable future. For example, if we are doing accounts for 2024, we assume that this business is going to be there to operate in 2025, 2026, 2027. So it's what we call going concern. So it assumes that a business will continue to operate indefinitely. It means the business will not be wind out. Wind out meaning the business will not go bankrupt. For example, if we have one business and we know the business is having financial problems, and we know that the business is going to close down, gulung tikar. I don't know in Indonesia what do you call it, gulung tikar? In Malaysia we call gulung. Do you know what is gulung tikar? Gulung tikar. Tutup.
I
Kan?
know.
So we cannot, in that case, when we prepare the financial statement, we have to follow the liquidation basis. Meaning the company is going to liquidate. Liquidate meaning we know a business, they have asset. For example, they have motor vehicle, they have furniture, they have property. If the business is having financial problem and we know the business is going to gulung tikar, we are going to close the business, all these assets are going to be liquidate. Liquidate meaning we are going to sell it to pay for debts. Yeah. To pay their liability, all this debt. So those are actually a different basis. Here, for the financial statement that we are preparing, we assume that the business is going to stay in business for the foreseeable future. Next year, next 2 years, next 3 years. And therefore, we can actually use historical costs, we can use fair value costs. So we apply whatever accounting standards applicable to that particular company. So when we look at the financial statements will be considered as part of a continuous series. So we know that there is a financial statement for the year 2021, the year 2022, the year 2023. So we can actually compare. These financial statements are comparable because we are following the going concern concept. Yeah. And when we look at the financial statement, for example, the current financial statement is actually reflecting the company's position or a snapshot of the business financial position at a specific period. We know there are 5 important components of the annual report. The first one is a statement of profit or loss. So that will report how well the company is doing throughout the accounting year. For example, how much revenue that they earn, what is their total expenses, how much profit they obtain, for example. And the second one is a statement of changes in equity. We are looking at the capital, the reserve, the retained earnings, opening balance, closing balance, what will be the change throughout the year. And the third one will be the statement of financial position. We want to find out what is the net worth of the company. We want to find out what is the total assets, total liability, total equity. So we can refer to the statement of financial position. And then we have What else? Statement of cash flow, right? So we need also to prepare the statement of cash flow, and then we have notes to the accounts. So all these statements are prepared assuming that the company is going to operate in the near future. Yeah, this is what we call going concern concept. All right. Okay. So for theory topic, such as accounting concepts, I will give you questions, yeah, just to see whether you follow or not the lecture. So what do you think? Under what principle or concept is depreciation charge on NCA? What do you think is NCA is a non-current asset? Example of non-current asset, for example, property, building, right? Land, for example, equipment, for example, machinery, for example, furniture, motor vehicles. So these are tangible assets, and we are going to charge depreciation on a machine, for example. So when we decide to charge depreciation, what is the principle that we are actually referring to? Under what principle is depreciation charged on? So far, you have learned business concept, business entity concept. And the second one is the monetary terms concept. The third one is the going concern concept. Which one do you think is the principle that we are following in deciding to charge depreciation on non-current asset? What do you think? Of the three principles that you have learned so far, which one is you think is the concept or the principle that we use when we charge depreciation on fixed asset or on non-current, on tangible asset? What do you think? What do you think, Fauzan? Is it business entity? What do you think, Akmal? Is it monetary term, or is the third one going concern? What do you think? Adinda, what do you think, Adinda? Anyone can respond, not a problem.
Maybe going concern, ma'am.
Good, very good. Thank you, Adinda. Is going concern. Yeah. If we are not referring to going concern, we cannot charge depreciation because we know the machine is going to be sold. We need, if the company is having problem, is going to close down their tangible asset. If they have machine, we are going to sell the machine. So we cannot charge depreciation. We are going to refer to the realizable value or the market price. Yeah. So the principle will be the going concern concept. Very good. Alhamdulillah. Okay. Now you are ready to move to the fourth concept, which is the accounting period concept. When you study, how are we going to measure your performance? You are going to sit for exam, right? And you're going to get your grades, your results. And your results is for a particular semester. You using semester or term? Semester, right? So that is what we call a period to measure your performance. So for business, we need to decide on what will be the period. And this period is what we call accounting period, so that we know when to stop adding the revenue. Okay, so the company will choose a specific time period. Usually it's 1 year to complete an accounting cycle. Usually, but the opening date and the closing date can differ from one company to another. It is very common to see company close their accounts at the end of the year, 31st December, right? But there are companies also close their accounts on 30th June, 30th September, or 30th April, 31st January. But all these are what we call an accounting period. Yeah. which is very important, so that when we prepare the financial statement, we know it's for one accounting period. So the financial statement mentioned in the accounting year, dividing the indefinite life of the organization into shorter equal time period. Kan? So this is very important because it helps us accountant to decide when to close accounts. We need to close accounts, for example, revenue accounts, expenses accounts, yeah. And we know when we assess the company's performance is on the yearly basis. Of course, we know for the listed company, they do have quarter reporting every 3 months. They have to report every 3 months. Yeah. So that is actually another reporting, because we need frequent reporting, so that the company will know how the company progress, so that they can take action to improve the performance. So by using accounting period concept, it will help performance comparison and provide stakeholders. Who are the stakeholders? The business owners, the shareholders, the investors, the lenders, the suppliers, the government entity, with timely information. And we can actually compare the performance. We can compare the year performance for the year 2010 to 23 with the year 2022, and we can compare against the year 21, and we can compare against, for example, if I think most companies, when we look at their performance, the performance at a very at the worst performance was during the COVID-19 pandemic, kan? In the year 2020, the year 2021, because it's where the pandemic has been spread out and government need to impose restrictions on movement. So businesses cannot open their business as usual. They have to close their account, close their shops. So they have to bear all the expenses, all the overhead expenses. So they report loss or very low profit during the year. So when we compare against the year 2021, 2022, we can see that the performance started to improve. How can we do this? By referring to accounting period concept. Yeah, we cannot prepare a financial statement. Say, for example, a statement of profit or loss for the year ended indefinitely. That is actually impossible. We will not be able to prepare the statement of profit or loss. We have to choose a particular date. So the statement of profit or loss for the year ended 31st December 2023, for example. Yeah. So that is actually referring to the accounting period concept, or sometimes it's known as periodicity. Yeah. But in your syllabus, they call it accounting period concept. Is that okay? All right. And then cost concept, which is actually now this is important, especially when we want to record the initial cost of asset. Yeah. So all firm assets are recorded at their purchase price. When we look at the purchase price, for example, you want to buy an equipment, the purchase price is, for example, 5 juta rupiah, for example. But you get a discount of 10%. So we are going to deduct the discount. All right. So you will only pay 0.9 from 5 million. You will only pay 4.5 million rupiah. And is that all? No, because sometimes you have to pay for costs, other costs such as installation costs, transportation costs. You have to pay legal fees, for example. So all this will be added up. All these are costs. Yeah. So this is what we call cost concept. So we use the historical cost, and then that's why we need to charge depreciation, so that we will be able to determine the carrying amount of the asset. And the market price of the asset is not taken into consideration, because here for specific assets such as the depreciable assets such as motor vehicle, machinery, equipment, all these will be depreciated because of wear and tear of the asset. So we are going to record it initially when we acquire, when we purchase the asset at cost. So this is what we call cost concept. Yeah. And then we also have dual, what we call double entry. Have you ever heard of double entry concept? Dual concept. Yeah. So for every credit, there must be a corresponding debit. Yeah. So for example, we know a human being, the either male or female. There's no in between. Yeah. So we don't agree that there is actually gender, which is actually mixed gender. No, it's either you are male or you are female. So dual concept, dual aspect concept. So for every transactions, we are going to have two entry. One must be debit, another one is credit. All right. So for every transactions, we are going to record in two accounts. Say, for example, if the business buy an asset worth 10,000, this is too low, 10,000 rupiah. So how are we going to record this? For example, this is an example. How are we going to record this? We are going to debit asset, credit, bank. Yeah. So the bank or cash will be reduced. So we are going to credit bank. So we have double entry. So for every transaction, there we have a dual effect on accounting and also the statement of financial. So that's why we managed to get the statement of financial position must be balanced. Total asset must equal total equity plus liability. Yeah. So it's derived from the accounting equation where we have asset equals equity plus liability. And we can expand it. Asset plus expenses equal equity plus liability plus revenue. Yeah. So revenue will be added. So usually we are going to put revenue minus expenses. That will be profit. And profit belongs to the owners. So we add to the equity. Yeah. So this is dual concept. Yeah. Dual, what do you call it? Dual aspect concept. Okay. So I think I will give you a 5 minutes break. Take a break first. Um, and then we will continue with effort and accomplishment in financial reporting. Remember how many concepts that you must know from for this particular course? You have to know 7. Yeah. So we have covered up to duality concept. So we are halfway through. So I think I'll give you a 5 minutes break. If you have any question, you can always ask me directly. Yeah. So we take a 5 minutes break first, and we'll continue with effort and accomplishment. Okay. We take a break. Okay. Assalamualaikum.
Waalaikumsalam.
Alhamdulillah. I heard that there's flood, yeah, all over Padang. So how about your place? No, but you are okay, eh? Hopefully you are okay. Um, right. So there are only, I think, about 4, 5 slides to go. And then I let you do the questions, and then we can actually um, end today's class. So far we have covered the concepts which are very important to users, no, to accountants. And these principles or concepts are those concepts that we refer to, meaning when we charge depreciation, we base on a particular concept. We don't do it because we know we just want to charge it. No, we must have solid principle that we follow. Yeah. So that is what we call, for depreciation, we charge depreciation because we are following we may follow several concepts. You may be correct to say that we charge depreciation because we follow concept A and concept B. That's fine. Yeah. Let's move to the next concept, which I would call effort and accomplishment in financial reporting. This is the first time I look at this concept in terms of effort and accomplishment. Usually, we just say it's actually matching concept or accrual concept. It's called matching principle. Yeah. So this is, remember, we are just now, we know that we have to follow the accounting period concept. So once we have decided the period, now we need to make sure that when we record revenue is for that particular period, because we are going to report for that particular. Say, for example, for 2024, we will record whatever sales that the company obtained starting from 1st January 2024 until 31st December 2024. So this revenue is for the year 2024. All right, so we start from there. So when we have revenue, of course, we need to bear expenses, certain expenses, such as the cost of buying the products, the salary for the employee, rental, paying electricity, and so on. So those expenses that meant for this particular period, the year 2024, which start from 1st January 2024 until 31st December 2024, these expenses are going to be expenses for the year 2024. We match expenses the year 2024 with the revenue for the year 2024. So that's what we call matching principle. So this is the fundamental accounting concept that govern how company recognize expenses in their financial statement. So when we look at this principle, this is where expenses should be matched with the revenue they help generate during the accounting period. So for example, if we are preparing a monthly P&L, so for the month of February, we will take all the revenue for February and all expenses for February. So we'll be able to determine, to calculate profit for the month of February. Yeah. So in other words, when a company earns revenue, it should also recognize the related expenses incurred to generate that revenue. All right. So this will make sure the financial statement reflect the true profitability of the business accurately. Yeah. So by applying the matching principles, it will promote consistency and transparency. How? By aligning the timing of revenue recognition and the recognition of associated expenses or costs. I'll give you one example. Yeah, if this is example for the, current sort of business transactions. So say for example, if we have one business, we call it A, for example, yeah? It's not, probably it's Adinda, I don't know whether Akmal or Adinda. We call it A. So A is a business, it's a software company that sells annual subscriptions for its cloud-based services. This is where for users who want to work on the go, so they need to store their files and document on the go, so they subscribe to these cloud-based services that provide storage for that they can access anywhere. So when a company purchases a subscriptions, the company receive revenue upfront. So usually when we pay subscription, we pay for one whole year, right? So it's for the whole year. Or it can be for 2 years. For example, I subscribe a software to analyze my data while I do my research. It's for a period of 2 years, for example. Yeah. So it's upfront. And then the company will incur costs. They will to pay for expenses to develop, to maintain, to support the software throughout the subscription period. So by following the matching principle or matching concept, the company will be able to match the cost against the revenue correctly. Yeah. So for example, if the subscription is actually for 2 years, the year 2024 and the year 2025, for the year 2024, the company can only recognize half of the total subscription. Yeah. So based on time. So therefore, the company will be able to recognize its revenue over the subscription period correctly. Yeah. So similarly, if for example you subscribe for data plan for your phone, for the internet, and you pay upfront, say, so for example, you pay for one whole year, so and the year overlap, because when you decide to subscribe, you cannot say, oh, I have to wait and for January to, no, if you need the data, you need to subscribe it there and then. So if you take it, so for example, you subscribe today, which is on the 8th of March, and it's actually for 1 year, so it will end next year, 7th of March 2025. So for the year 2024, the company can only recognize for starting from 8 March until 31st December, if the financial year ends on 31st December. And the costs that the company incur to provide those services, they will match it against the revenue, the subscription fees. Yeah. So this is what we call matching concept. All right. Is that okay? Anyone has any question? Putri, okay, Putri? So your name is Putri Fatina Turrahmah Alva.
Yes, ma'am.
All three. What about your father's name?
Alpha is my father's name.
Oh, okay. Alpha is your father's name. All right. So you are Putri Fatia just now. Okay, good. It's good. I'm quite. I think it's good that I have experience teaching students in Scotland when I did my PhD. So now I have the opportunity to teach students from Padang. So I'm very happy to have this opportunity. I really hope I can help you to learn about, for example, today about accounting, important accounting concept. Anyone has any question related to matching concept? You can read, actually. I know it's theory, it's a little bit dry, but I really hope you can understand it so that you can relate it with the accounting transactions that you do in the past or in the future when you work. Yeah. So we move to the next one, which we'll call verifiable and objective evidence. This is very important, especially when we know that the financial statement are going to be audited by external auditors and they look for evidence. Yeah. And now we are moving towards fair value accounting. Evidence will be an issue because usually when we use the market value, we don't actually I mean, we just say we refer to the market value at a particular date. But in terms of evidence, it's not as objective, as strong as if you use historical cost. But we cannot stick to historical cost if we use historical cost for all assets that will make the figure or the information to be very out of date. Yeah. All right. So therefore, the verifiable and objective evidence is a concept that we have to bear in mind. So when we look at this concept, it states that no accounting record should be created unless it is supported by independently verifiable evidence. We need to come up with evidence. Even though we are using fair value, there are procedures that we need to follow. We cannot just, plug any numbers to be the fair value. We must be able to provide independently verifiable evidence. Say, for example, we refer to the market price on a particular date, for example. Yeah. So this evidence is typically in writing or should be reduced to writing before an accounting entry is made. So for fair value accounting, we really need to follow the steps strictly, yeah, so that we'll be able to justify and defend the figure. So every transaction must be evidenced by a document. For example, for cash sales, the evidence will be cash memo or cash receipt. Yeah. For credit sales, the evidence will be the invoices. So that's why when your company purchase goods, when the goods arrive, delivered, you have to sign the delivery note, for example. So invoice and then supported by the delivery note, for example. Yeah. What about payments through the bank are verified by checks. So we can download the receipt and show that receipt as the evidence. For example, if a company, a business purchase significant assets such as land, buildings, and vehicles, we here auditors, I used to work as an auditor for 1 year. We are going to refer to the legal documentation. For example, the sales and purchase agreement, the title dates, the sale dates, the legal documents, all these are evidence. Yeah. Okay. No questions so far? So far, okay? All right. And accounting assumption, yeah? So accounting assumption here, there are assumptions that we have to make. We have to make when we make a particular decision. So when we prepare the financial statement, we are following the full disclosure assumptions. But of course, we cannot provide too much information that will not help users. That will cause problem to users because they are suffering from information overloading. So we are going to provide full disclosure for all the important relevant informations. Yeah. So the company must disclose all relevant information that could impact users' understanding of the financial statement. So that's why we need to provide notes to the accounts. If you remember, when we look at the notes to the accounts, there will be company need to provide what will be the basis of accounting, what will be the accounting policy, how do they charge depreciation, what will be the depreciation rate, how do they measure investment property, for example. So they need to provide those information in the notes to the accounts. Yeah. Notes, explanations, and supplementary details will be provided, because this is also important, because when we prepare the financial statement are going to be very standardized. Yeah. So the detail is in the notes to the accounts. I think later I will show you an example of the annual report where you will see the notes. Yeah. So having said that, conservatism assumption is another assumption which is also very dominant and very important. We are, accountant, sorry, you see my WhatsApp notification. We are somehow prudent or conservative, because here, mm, conservatism is where when we are facing uncertainties, the company should choose accounting methods that result in lower profits and higher liabilities, because we don't want to provide information which is actually unrealistic, or too, it doesn't reflect the true and fair view of the business performance. So for asset, we don't want to overstate asset. That's why for inventory, for example, we are going to exercise the valuation of our inventory. We are going to compare the carrying amount with the realizable value. We are going to report the lower figure. And then, so for example, inventory, the carrying amount is actually 10 million, but the realizable value, when we check the market price and so on, is only 9 million. So we are going to report 9 million. 1 million will be written off. We call it inventory written off. We charge to PNL. Yeah. So we are being conservative. We are being prudent. All right. So we come to this, I call it brain teaser, just to check you understand. Having a go read the question. According to what accounting concept, while preparing accounts, we anticipate losses? A, materiality. B, objectivity. C, conservatism. D, none of the above.
Oh, conservatism.
Yes, conservatism, right. Good. Any objections? Anyone disagree with that? So this is what we call, when you as an accountant, when we prepare accounts, we anticipate losses. That's why we make provision. For example, if a company is facing legal claims from, for example, if one of the customer suffered injury while using the company's product. So this particular customer sue the company, take legal action. So the company's accountants will assess the probability that the company is going to find guilty and must compensate the customer. So they will make provision if the company is probable to lose the case and must pay the customer. So they will make provision for legal claims, for example. Yeah. So this is why, because when we prepare accounts, we anticipate losses. So it's actually following the conservatism concept. Very good. And then another concept is what we call consistency. We have to be very consistent. When we apply a particular accounting treatment, we have to stick to that treatment in year 1, year 2, year 3, year 4, year 5. If you want to change it, we have to provide basis. We have to provide justification why we change the accounting treatment. So this is actually because we are following consistency assumptions. It means that accounting methods and practices should remain unchanged over time. So the company should apply the same accounting principle consistently from one period to another. For example, if the company depreciate building, the company purchased building A and the company depreciate the building in year 2021. So meaning in the year 2022, the company need to depreciate the building again. And the same goes in the year 2020 and so on. It must be consistent. All right. So if the building has been, the company stopped occupying the building and rent it out to tenants. Now we need to reclassify. The building is no longer property, plant and equipment. It must be reclassified as investment property. Yeah, that is a different case. Yeah, so therefore here, if the building is actually occupied by the company and the company decided to depreciate the building, the company should depreciate the building from 1 year to another consistently. Yeah. So by doing this, it will help. It will increase the comparability of the financial statement. Yeah. And it will enhance the relevance and reliability of the financial information. Yeah. So this is, we have to be consistent. In Islam, we have to be istiqamah, right? So, for example, if we pray right on time, once we heard the azan, we pray. So we have to be consistent. If we pray solat sunat, 2 raka'ah, ba'diyah or qabliyah, we have to be consistent. So that is actually good for us. But for financial accounting and reporting, we need to be consistent. If you are advising the company in terms of financial accounting matters, the company need to decide on accounting policy, discuss about it thoroughly, choose which one is the most appropriate for the company and stick to it. Yeah, be consistent. All right. So this is actually very important because there are various accounting standards. There are many accounting rules and regulations. So if you look at a particular accounting standard, there will be alternative. The prescribed accounting treatment is actually A. Company can choose whether to apply A or not to apply A. Once they decide to apply A, they have to do it consistently. Yeah. So for every accounting standard, of course, company need to, there is what do you call it, rooms that actually company can actually decide not to follow the accounting treatment due to several reasons. For example, because it's going to be very costly for the company. So this is related to pervasive constraint of financial reporting. If it is going to be very costly, very burdensome to the company can decide not to apply a particular accounting treatment, but of course the company need to provide justification and explain. So this is what we call the pervasive constraint of financial reporting, because we know financial reporting is highly regulated. Especially for public companies, they need to follow the approved accounting standard and they must follow it consistently. If, for example, it is very costly for the company to follow fair value accounting, the company can decide not to follow it because this is what we call the pervasive constraint of financial reporting will be when the benefit is actually, when the cost is greater than the benefit. It's too costly. Yeah. So this is the constraint. Yeah. Although we know every company, public entity must apply accounting standard, but if to apply that particular accounting standard, it's going to incur very huge cost. They have to change their information system and so on. So in that case, the company can choose not to follow that particular accounting requirement and justify by saying that the cost is actually greater than the benefit. Yeah. So this is although you have learned about all those concepts, and this concept are actually the basis for applying accounting requirement, accounting standards. However, there will be exceptions, exemption and exceptions, especially if the cost of providing is actually greater than the benefits of information that they provide. Yeah. Right. Anyone has any question? this is my last slide. I open for Q&A if there are any questions. I'm gonna share with you the slide in chat box. Let me just from my computer. We just share the slide here. Can I share the slide here, or I need to close my file? Share it here. And then last is the tutorial. There are only 10 questions. Ada yang multiple choice. Ada 10 sahaja yang saya cuma sempat buat 10 questions. You give it a try. Saya akan tengok how you do it. And then that's all for today. Unless if you have anyone has any question. Oh, can you click on? Kenapa jadi begitu ya? Okay. This is my tutorial. Can someone try click the link? Can you click the link?
Yes, we can, ma'am.
Okay, all right. Can you respond to the question? I've set it to be anyone can click the question. If you have any problem with it, is it okay?
I think it's okay, ma'am.
Okay,
That is
good.
good.
Okay. So in that case, I guess that's all for today's class. Anybody has any question? Are you all okay? Have you learned something? For accounting theory, you have no choice but to read and, comprehend, understand it, and you can explain to your friends your understanding so that your friends can check. Oh, okay, that's correct. Okay, that's not correct, for example. Yeah. So you need, if you look at the tutorial questions, you will see there are actually questions on, for example, what principle that you use when we record asset, for example, it's historical cost. But what principle that we use when we record liability, for example? Yeah. So you need to check which principle is related to that. So have a go at the questions, and then it's about 12:30 now. You have another half an hour. I think you will spend about half an hour on the question. I'm just want to say that for accounting theory, the accounting theory will help you to understand why we do a particular accounting treatment. All right. So it will help you to understand why we are doing this, why we are not doing that. So the two topics that I cover, the conceptual framework will be the main guide. Guide to whom? Guide to the body that develop accounting standards and also rules, accounting rules and regulations. So that the accounting standards are going to be developed based on a consistent basis. Yeah. So we start with the objective for financial statement. We want to provide useful financial statement. All right. So to be useful, that's why we need financial statement to be prepared by following specific accounting treatment and requirement, so that we can make comparison between company A and company B in the same industry. We cannot compare between different industries. It's not fair. So for example, if you take manufacturing company, we have, for example, company A and company B. By following the accounting standard, if you are an accountant of company A, your accounting, the way you record accounting transaction will be similar to the way accountant in company B, because we are all following the same accounting standards. And the accounting standards are developed based on very concrete, consistent basis. Okay? So that is why the conceptual framework is very important, and also the accounting concepts, principles, and assumptions are also very important to all accounting students. Yeah. So when you want to justify, why you want to defend a particular accounting treatment, you can refer to the accounting concepts and assumptions. It's going to be very challenging when you work later. Your boss might want you to record a particular transaction differently, but you know you have to follow the accounting standard. So you have to explain it, and you can use accounting conceptual framework, accounting concept, accounting principle to defend your decisions. All right. So I wish you all the best for the rest of your classes. Okay. Accounting is a study which is very specific. We train you to be an accountant. So therefore, it is very important you understand a particular concept, accounting concept, or principles, so that when you make decisions, your decision will be in line with the accounting regulations. Okay. And I also would like to apologize if there are any, any mistake done by me. I'm happy to be given this opportunity. So I wish you all the best in your study. Probably we will see again in the future, inshallah. Anyone has any question? If there is no question, we'll end our today's class. But please do the tutorial. I will check your tutorial online. Yeah. Thank you so much. Assalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam.
Waalaikumsalam
Waalaikumsalam.
warahmatullahi
Thank you, ma'am.
Thank you,
You're most
ma'am.
welcome. You're most welcome.